Okay, in this series of videos, we're going to take a look at estimating cash flow as part of the capital budgeting process. We're going to be coming up with those cash flows, estimating those cash flows so that we can then apply the rules that we talked about in previous chapters, where we look at the NPV, the IRR, the payback, the profitability index, those sorts of things, to make a decision whether we want to ultimately go forward with this project, whether we want to make this investment or not. So the first thing we're going to consider as we look at estimating cash flows is to think about the difference between accounting income and cash flows. So when we're evaluating projects, we really do care just about cash flows. We're going to consider cash flows. We're not going to really concern ourselves with how accountants keep track of things. One important reason is because a project can be profitable in an accounting sense. That is, it can have more revenues than expenses, but it can still be a negative NPV project. And the reason is that the timing of those cash flows matters whenever we're thinking about it in an economic or a financial sense. Accounting doesn't really take into account the timing of the cash flows. All cash flows are treated equally regardless of when they happen. In an economic or a finance sense, we do care about the timing of those cash flows and the discount rate as well. So if the discount rate is relatively high, the timing of the cash flows becomes very important when we consider the profitability of a project in an economic sense. Another important difference between accounting and looking at cash flows comes in the example of the investment, the initial investment. So for instance, whenever a large cash outflow is made for a project, from an accounting standpoint, that's usually capitalized, added to the balance sheet as an asset, and then depreciated or expensed over time. But from a finance standpoint, when budgeting, we're going to consider that initial large cash outflow as a large cash outflow that happens at one particular point in time. Depreciation will still enter into things, and we're going to talk about that in future slides here. But we only care about depreciation insofar as it affects the real cash flows of the firm, and in particular the taxes that the firm pays. So the critical difference is we're going to look at cash flows here, not just accounting numbers. So a few adjustments that we are going to make to cash flows to get to those bottom line numbers that we can apply the net present value rule to, the IRR rule to. The first thing is depreciation. We're not going to deduct that from the cash flows for the project, primarily because it's a non-cash charge. Don't ever write checks for depreciation. It's not a real expense. But it does affect taxes, so we're going to consider depreciation. It's going to be a part of our calculations, but our cash flows, we want to make sure that we're not taking out depreciation from those cash flows like we would if we were accounting or doing accounting, because it's not a real cash flow. Second thing we want to take into account is the changes in working capital, because those are real cash flows for the firm. So for instance, a lot of times when new projects happen, when a firm goes forward with a new project, they will have to make incremental investments in cash, accounts receivable, and inventory. And also it's likely that there will be incremental increases in their accounts payable and accruals. And when we net all those things out, we will likely have an increase in the net working capital of the firm, and that's going to require cash. If you remember back into the discussion we had with financial statements and looking at statements of cash flow, whenever there's an increase in cash or an increase in receivables or an increase in inventory, that is a use of cash. An increase in accounts payable and an increase in accruals is a source of cash. But if we net those two things out and we have an increase in the net working capital of the firm, that results in a use of cash that we really do care about in a finance sense, and it's going to be a negative cash flow to the firm up front. Now later on we may recoup that increase in the working capital. As we work through some examples, you'll see that we will typically unwind that initial investment in working capital, and we will recover it at the end of the project. But the timing of those cash flows matters, so we're going to up front we're going to consider the increase in working capital, and then at the tail end of the project we may decrease the working capital to show that the project is kind of going away and we're unwinding things. And then lastly, we're not going to include interest charges Now, and this is a little bit of a difference with some other things. Even though it's a cash flow, even though it's a cash expense, we're not going to count the interest paid on projects because our weighted average cost of capital already includes our cost of debt, and we don't want to double count the interest charges against the project. So the WACC already includes our cost of capital, so we don't want to include any cash flows that are related to our capital charges or our cost of capital. So with those three important adjustments in mind, we'll move on and think about this really big idea when we're creating the cash flows for analysis, and that is the idea of incremental cash flows. It's a huge idea in evaluating projects and making financial decisions. We want to examine the cash flows in one scenario, and we want to see how they differ from the cash flows in a different scenario. And so those differences between the two scenarios that we're considering is defined as the incremental cash flows. So you can see an easy example here. If we don't go forward with the project, we'll have no cash flows in year up front, no investment up front. We'll have no cash flows in year 1, no cash flows in year 2, no cash flows in year 3. Whereas if we go forward with a particular project, we might have an initial investment of $500. Our year 1 cash flows at the end of the day we expect to be $350. Year 2 cash flows are $250. Year 3 cash flows are $150. And the difference between those two scenarios are the incremental cash flows. And in this case, it's really simple to see that the difference is just between cash flows that we get from going forward with the project. But the big idea is that it's the difference between these two. So another example of incremental cash flows, let's look at a replacement project. And in particular, this has in view the idea of we are making an investment to replace all the lighting fixtures in our building. So we've got the one scenario, the go scenario, go forward with the project where we replace all the fixtures. Our initial investment is $100,000. And these series of negative cash flows are what we expect our utility bills to be, in particular our electricity bills to be, once we've replaced all of these light fixtures. So in year 1, we expect to pay $6,500 in electricity. Year 2, $7,000. Year 3, $7,500. And these are increasing because of inflation in our electricity charges. The alternative here is that we don't do anything to our lighting fixtures. We just leave them as is. We don't replace anything, and we just use these kind of inefficient lighting fixtures. Our electricity charges are going to be higher, and you can see that. In year 1, our electricity, if we did nothing to our fixtures, our electricity bill would be $20,000, growing over time. So looking at the incremental cash flows, the difference between these two scenarios, you can see that up front, the difference is $100,000 in year 0, because I'm in the one case in the replacing fixtures scenario, I'm spending $100,000, and if I do nothing, that scenario, I spend nothing. So the difference between those two is $100,000. Now in year 1, it becomes a little interesting here. I'm better off by virtue of going forward with this project. I'm better off by $13,500. That's the incremental cash flow to me of going forward with this project. Now notice, even though I'm spending $6,500, the idea is that I'm incrementally better off by the $13,500. So again, incremental cash flows, it's a huge idea, and we want to just look at the differences between one scenario and the alternative scenario, and only whenever there are differences do we really care about them. So we'll pick up from here in the next video.